Good morning from London. I'm Anna Edwards alongside Guy Johnson. We're an hour away from the opening trade. Here's what you need to know. Power outage. Europe's EV battery ambitions take a knock as Sweden's Northvolt files for Chapter 11 bankruptcy. PMI data is set to shed light on the state of Europe's biggest economies. We'll also bring you a keynote speech from the ECB President, Christine Lagarde. Plus, Donald Trump nominates longtime ally Pam Bondi to run the US Justice Department. This after Gaetz, his controversial initial choice, bows out of the running.
Let's talk about these markets, Anna. Let's figure out what's going on. Eurostoxx futures are not doing anything this morning. We're going to wait and see. We've got PMI data to get through. We've got Lagarde to get through. We'll bring you all of that in this show. The action is in Asia this morning. The CSI is down 3. CSI 300 is down 3%. Technology stocks the reason for that. Euro dollar is below 105. Again, I take you back to the PMI and Lagarde. But the real story of the morning, will it, won't it? 99 is where we are. Do we get to 100 on Bitcoin? The countdown to the opening trade this Friday starts right now. Good morning. It's Friday. We made it. We're not quite through it yet, though. There's plenty of action still to come. Europe and the United States just feel on different planets this morning. We are watching the situation at Northvolt, the hope for Europe's battery production. We're going to get PMI data this morning. It's expected to be ugly. What is Lagarde going to say a little bit later on? All of it points to a picture of European stagnation at a time when the United States feels like it's moving ahead aggressively as we prepare for the Trump presidency. This Northvolt story this morning, Anna, I think it just is emblematic of the struggles that we are seeing here in Europe, the car sector at the heart of it, and it just speaks to this stagnation, this lack of structural sort of flexibility that Europe has right now. Yeah,
all the questions about the European growth model and the deficiencies of it right now. This has been the poster child for what Europe could pin its hopes to, Europe's fight back in EVs and in batteries. And we've seen Asian competition really bring down the price of these batteries to such an extent that the business finds itself in considerable amounts of trouble. They're going to continue their operations at the Arctic Circle. They've reduced their headcount by about a quarter. They go into Chapter 11 bankruptcy, and that does give them more flexibility around some of their creditors, who also seem to be some of their customers as well. But this does raise big questions about planned expansions in Germany, in Canada and elsewhere.
This is a business that hasn't really produced any batteries, though. That's the other real problem with this, that we've seen significantly lower battery output than was originally anticipated. The business seems to have scaled far faster than was anticipated. But this is at the core of the crisis that we're seeing in places like Wolfsburg right now, as Volkswagen struggles to make its EV transition, Ford cutting thousands of jobs in the UK and in Germany. Europe doesn't seem to be able to catch up right now. How it does that remains an open question at a time when there's so many stresses on so many other areas. And you do wonder whether Christine Lagarde is the only one that can really take action here. Governments seem to be really struggling.
Yes.
But is more debt the solution? Are lower rates the solution? Or is significant structural reform the solution?
And we'll get into that Eurozone growth story in just a moment. Quick detour via the UK growth story, which actually looks, based on our PMI expectations today, the UK numbers expected to come in better. But we've had retail sales numbers out for the UK, 0.7% month on month. That is a drop in retail sales. The estimate was for just a drop of 0.3%. And I think the reason we mentioned this is just because this is having an impact on the pound. The pound was already weaker by 0.1% or so. Now it's down by 0.3% against the US dollar. I mean, a cautious pace of rate cutting has been the mantra that we've heard from the Bank of England, but here's an area of weakness. But we could point to the data we got at midnight, which was also of a consumer-facing nature in the UK, and that was a little brighter. But the pound trading on these, and the pound really trading on these headlines.
Yeah. I do wonder whether this next number, though, will look a bit better. Isn't it Black Friday? Do you just wait until...
How many people go shopping, Guy?
Rumour has it.
Yeah, that's the thing.
A lot of... Maybe a little kind of... a little bit of saving before that spending. Christine Lagarde's going to be speaking very soon.
Yes.
We'll bring you her speech that she's going to be delivering in the next hour. Before that, though, we're going to get some PMIs. And the PMI data out of Europe, you look at the German numbers, basically they're not expected to get significantly worse, but they are already at horrible levels.
They are. Manufacturing is weak everywhere. Germany, we've actually got services expanding, so that's one area of brightness, but the composite number is below 50, expected to stay there. The French number across the board on services, manufacturing and composite, we're expected to be below 50 with a 40 handle once again. So there's a real focus on what the ECB does, and therefore we listen to Christine Lagarde very carefully. We heard from Stenaris just yesterday, talking to Francine here on this set, saying that, you know, he thinks every meeting there should be cuts. He's not ruling out one of those being as big as 50 basis points, but that doesn't seem to be his base case.
But he is talking about the uncertainty. He is talking about the caution that maybe is required at this point. Yes, maybe we do get 25 basis point cuts coming through. Someone's suggesting, though, that we need to be seeing delivered 50 basis points being delivered here in Europe. We need to get to neutral as quickly as we possibly can. Many of the central bankers I'm listening to here in Europe don't seem to be treading that line just yet. And the sense seems to be we need more information. We don't know so much about what Trump is going to deliver yet, and we don't know what impact that is going to have. So maybe we're cautious.
Yes, we're cautious. We don't know about Trump. We don't know what reaction function that will then prompt from Europe, which is going to be crucial, of course. But the other factor in here, and this is a slightly left field, but Eurozone wage growth, you know, it's a bit backward-looking, and maybe it's a feature of where we've been, not where we are going.
Yep.
But we have had that strength coming through, and a lot of people pointing to actual real wage growth as being something that might change the narrative a little bit in various parts of Europe.
People talk about wage growth being a sort of lagging indicator of what's happening with employment, but you think about it, you get a pay rise, you don't spend the money instantly. It is something that takes time.
Yeah, and it might not be inflationary, but might it be positive for the consumer at the margin? But we'll have to see.
Kind of doesn't feel like it at the moment, judging by the data that we're seeing on our screens this morning. Let's get back to what is happening in the United States. We are watching very carefully how this Trump cabinet comes together. We've got a change at AG now. Gaetz is stepping aside. Bondi's going to be stepping in. She looks more confirmable, judging by what I've been reading in terms of the commentary that seems to be coming out of Washington surrounding her. We've also got Gensler stepping down. We're waiting for the Treasury Secretary. But I think
I was going to say, that's the big thing we don't know.
We don't know that. But Gensler is going to be stepping down. And he's been a thorn in the side of Wall Street. And you do wonder, you can see what happens with Bitcoin this morning. Is that in the price? Is his departure in the price already, or is this just an extra fill-up maybe for kind of risk assets and deals getting done, etc., etc.? Yes,
and Bitcoin, as you've mentioned, we're watching to see if it gets to 100,000. And there's been talk of putting somebody in the White House who's going to have a remit around crypto. But Trump had already said that he would fire Gensler, and Gensler was appointed by Biden. So to your point about whether it's already in the price, maybe it is. Maybe this was widely anticipated. But he was somebody who took a kind of a heavy swing at Wall Street, not just on crypto, but certainly the crypto space, very critical of the lack of space they were left for manoeuvre within a sort of old regime, an old rule structure as they saw it, a lack of space for this new asset class.
Treasury Secretary, we're going to get one at some point.
Yes.
And maybe it'll give us a clue as to who the next Fed chair is as well.
Yes, there's this Wall Street Journal report out this morning, you know, just another bit of the colour that we're getting around this conversation. We have no answers yet, but there's talk about, in the Wall Street Journal, whether Warsh might be given Treasury Secretary, but then with a view to moving to the Fed. But, you know, as I say, a lot of noise.
A lot of noise. We're going to try and find some signal in all of this noise. We've got some great guests to do that throughout the show. Michael Brown, Pepperstone Senior Research Strategist, joining us shortly. Pierre Muscovici, former European Commissioner, former French Finance Minister, is going to be joining us a little bit later on. We'll talk about what is happening here in Europe. Beata Manthi, Citi's European Equity Strategist Head, is also going to be joining us. What is the case for Europe at the moment? It seems very gloomy and dark this morning, certainly judging by what we're seeing in the headlines and what we're about to get, potentially, Anna, with those PMI numbers.
Absolutely. So we'll certainly focus in on that PMI data. That's going to be, if we look at the trading day ahead, then the PMI data really does catch our eye. The French data at 8:15, that's UK time. The German data 15 minutes later at 8:30. So we'll get all of that, and all of that builds up towards hearing Christine Lagarde speak at 8:30 UK time. So there's a lot to think about in the Eurozone story. We'll also get UK PMI and US PMI a little bit later on today. The UK PMI coming at 9:30, the US number at 2:45. So through the day we get that story building. I mean, relative strength, if you look at the PMI data out of the UK, although we accept that that's not the story being told by the retail sales data this morning. And in the US, we still have quite a strong services picture, but, you know.
Very strong services picture. And the ISM continues to flag that, though manufacturing continues to bump along the bottom. Wouldn't it be nice if they just put all the PMI data out in one...
Would that be nice? That'd be too much for me to read.
Bucket. But at least then you could you get a sense of kind of comparing and contrasting, and Maybe then we could talk to Chris Williamson as well. Let's talk about what else you need to know this morning and figure out what is front and centre. The French aerospace and defence supplier Thales is under investigation by both UK and French prosecutors for suspected bribery and corruption. The investigation is looking into suspected bribery of a foreign public official and influence peddling concerning a weapons contract in Asia. Thales says it is cooperating with prosecutors, adding that the group, quote, complies with all national and international regulations. The Spanish government has raised the maximum special tax rate to 7% on the country's biggest banks, prompting an immediate industry backlash. According to local newspapers, the new rate will apply to banks that make more than €5 billion in annual revenue from interest and fee income. That would apply to lenders including, yeah, you guessed it, Santander and BBVA. And Citadel founder Ken Griffin says he is wary of the long-term impact of tariffs, a key part, of course, of President-elect Donald Trump's economic agenda. Speaking at the Economic Club of New York, he was speaking with Sonali Basak. I want to point that out as well. He explained why tariffs may do more harm than good.
I am gravely concerned that the rise of tariffs puts us on a slippery slope towards cronyism capital.
Ken Griffin.
Yeah.
Sonali Basak.
Really interesting, his views, because he's a big donor to the Republican Party, not necessarily to Trump. And so he's a really interesting voice to listen to. And it's interesting to think how much airtime will those kinds of voices be getting in a Trump administration. We will see. But he talked there about tariffs. It'll be a sugar rush for the US economy initially, he conceded. But then after that, it leads to reduced innovation, which doesn't help. He also had really thoughtful things to say about immigration, and he wants the US immigration policy to be thoughtful. He doesn't want the United States to sort of close its doors to many of the immigrants who've come and made their fortunes in the US. And so he's certainly pushing that line. And tax cuts. He was cautious actually on tax cuts, saying, yes, sure, tax cuts, but careful with the deficit. And that's going to be, into 2025, something of a market preoccupation.
He is clearly concerned about the level of debt the United States is carrying right now, and that growing debt, and how much of that, how much servicing that debt is costing the United States right now. But he talks about the immigration story and wants it to be thoughtful. This feels like the underestimated story at the moment. We're all focusing on tariffs, but the US economy has grown as fast as it has recently because of immigration, and it has kept inflation under control. And you think about maybe removing, therefore, a key pillar of that kind of US growth story, and you wonder what effect that could have. Are we looking in the wrong direction, focusing on tariffs, when we should be focusing on immigration? Right,
so when we're thinking about what's going to be inflationary, perhaps there are other things to talk about, not just the tariff story. We will continue to do that. Coming up on the programme, Bitcoin flirting with $100,000. We will be monitoring all morning. We'll tell you if it crosses that line. Plus, we'll be looking for clues on monetary policy from the ECB President, Christine Lagarde's speech. That's a speech to the European Banking Conference. We'll bring you that live at 8:30 a.m. UK time. Up next, the euro is in focus ahead of key PMI data. That's coming around an hour from now. We'll get the French numbers, and then the German numbers follow quickly after. If you want to get involved in any of our conversations this Friday morning, IB plus BBTV Go, that is the function you can use on your Bloomberg terminal. This is Bloomberg.
Treasury Secretary is a very important role, somebody who understands capital markets, somebody who understands trade, which is clearly very important to President Trump, and somebody who can really help to make sure that they're on the agenda of making the American economy be everything that it can be. And so it's that. Let's hope that we get a candidate who ultimately will be able to do that, but it's great that there's a broad net here.
BNY CEO Robin Vince talking about the candidates for US Treasury Secretary. When are we going to get the news? I guess he probably has time still to make up his mind. Anyway, the president-elect is going to make a decision at some point on who is going to be the Treasury Secretary, and by extension, possibly, who could be the next Fed chair as well. Valerie's here to tell us more.
Yeah, right. That's exactly right, Guy. The market is still waiting for the announcement of this Treasury Secretary from the President-elect Donald Trump. It's notable that we heard from the Wall Street Journal overnight that Kevin Warsh could be the pick for Treasury Secretary, with the guise that he would replace Powell in 2026. And then on the Treasury Secretary side, Scott Bessent would then replace him as Treasury Secretary. So a bit of a musical chairs maybe being suggested by the Wall Street Journal reports out earlier this morning. There also has been some musical chairs when it it comes to the SEC, Gary Gensler has announced his plans to step down before Trump's inauguration in January. If we flip on and just take a look at how the price action of Bitcoin, it has been a positive few days for Bitcoin. It is above that 99,000 level now. The promise of deregulation with this big crypto hawk, Gary Gensler, now out of the SEC, is the bull case here for cryptocurrencies generally. But let's flip on and also talk about the other thing we have our eye on here in Europe, Guy, which is the European PMIs expected to come out across the morning. Now, the manufacturing PMIs, which I have here on screen, are still under pressure, not just in Europe, but globally in the UK and in the US, all in contraction territory. This German line, this line here in blue, still very much in the doldrums. It's at 43. It was a improvement from the prior reading of 41, but that is still deep in contraction for the manufacturing hub of the Eurozone. A lot of that has been priced in. If we take a look at what's been going on in FX, we had the euro dollar had a sustained break through 105 yesterday. This is as a speculation grows that perhaps we could have an ECB going for a jumbo cut in December. There is some price action in the front end that would suggest that we're now seeing above a 25 basis point cut priced in for that December meeting. We do hear from Lagarde as well today, Guy. Notably, though, she does speak before the big Eurozone PMI number drops today.
Valerie, thank you very much indeed. We've also just had, let me just bring it up on my screen, German revisions when it comes to the PMI. This is final numbers coming through. They have been revised lower. So this is final Q3 numbers revised to 0.1, down from 0.2. The numbers just slightly keep getting worse and worse. The bad news doesn't stop, it seems. We thought we'd maybe priced it in, but maybe we haven't. Let's talk more about this. Michael Brown is a senior research strategist at Forex and CFD broker Pepperstone. Good morning.
Morning.
When do I get the parity print?
I think parity could be quite a way off, to be completely honest with you. I mean, as we were saying a moment ago, the bad news does keep coming for the euro. It's one thing after another, whether it be geopolitics, whether it be dovish ECB speak, whether it's the threat of tariffs from Trump, whatever it may be. You've also got the perfect storm of the news keeps getting better and better from the US side of the equation. But I think you also argue, actually, a lot of bad news is in the price at the moment. And when you think about things like a 50 basis point ECB cut, no one's really touting that from the ECB just yet. So I don't want to say things are as bad as they're going to get, but I think parity is probably a little bit ambitious right now.
OK, ambitious from 1.04. We'll see. We'll see how long it takes to get there. And if we do, to your point then, Michael, I mean, I've been reading a bit of research from people who are trying to find silver linings for Europe, trying to find reasons to not be quite so gloomy. And some of them point to, when you're thinking of assets, cheap valuations and everything being thrown out with the bathwater. And some people point on a macro level to real wages and perhaps the potential for real wages to slowly start to deliver something better on the consumer side.
Well, I think the first thing I'd say on valuations is the Eurozone is cheap for a reason. You know, we're talking every day about how grim the economic news is out of the Eurozone.
Some of them aren't really exposed to the Euro... Well, not entirely exposed to the Eurozone economy. Big global names sort of, thrown out with the rest.
I agree.
Perhaps unjustifiably.
There is probably a degree of that going on, but also you look at something like the luxury sector in Europe. You know, Chinese demand has just fallen off a cliff and is showing no sign of recovering anytime soon. You know, there are very, very few bright spots in Europe. And I think you would have to search really, really hard to find one of those silver linings, particularly when the threat of what could be sort of indiscriminate trade tariffs is hanging over the Eurozone, whether it be the equity or the foreign exchange space. It's really tough to be buying into anything with any conviction in that sort of environment.
So what do? Do you just expect these valuations to continue to widen? Does Europe continue to look grimmer and grimmer? Is that the outlook?
I think it is. Unfortunately, I hate to deliver such a pessimistic story on a Friday morning, but I think it really is a case of Europe is heading further and further south. There are fewer and fewer bright spots, and stateside things are getting brighter and brighter and brighter. You know, you're talking about the potential for more stimulus, the potential for tax cuts. That should be a bit of a fillip for US economic growth. What hope has the Eurozone got? Another 25 basis points from the ECB? Is that really going to solve some of the structural issues that we're dealing with in the Eurozone? I struggle to buy into that argument.
What about the pound?
Well, I think sterling is in a similar boat. I mean, the one thing that could help to support the pound a little bit is the idea that the BOE are probably going to be much less aggressive with easing than their peers.
Yeah.
But I think they're going to be more hawkish for the wrong reasons, because we're dealing with sticky and stubborn inflation here in the UK, particularly on the services side, again at 5% earlier in the week. So are you dealing with sort of stagflation light here in the UK? Services inflation sticky. Retail sales were poor about 20 minutes ago. You know, yes, you've got a hawkish BOE, but is that enough? Are they hawkish for the right reason?
I guess one of the reasons you can argue that maybe the UK is in a slightly better position, similar boat, but not the same boat, is that it doesn't have the same goods exposure to tariffs that the rest of Europe does, the Eurozone does.
Yes, absolutely. And we've heard that from a number of people when they're looking across Europe and the options, the investable options out there, and they say, well, maybe the tariff story falls more heavily on Europe than it does on the UK because of the services nature and also because of the trade balance not looking so heavily weighted in one side or the other. And talking of trade takes me to China, Michael, because we've seen real weakness in the China equities market just this morning. Stands out, actually, amongst the rest of Asia, not looking quite so gloomy. But there does seem to be constant concern about what's going to be done to support the Chinese economy. We heard from Philip Lane just overnight, playing down any hopes that Europe has about recovery in China being a real catalyst. I mean, when even Philip Lane is not pinning... he's not pinning any hopes for Europe on that kind of dynamic. He says whatever happens, this decoupling hits China really hard. So that's not going to be a source then of recovery for Europe.
No, I don't think it is. I mean, if you look at what the Chinese authorities have done so far, the stimulus has been very, what I would call, market-focused. It hasn't really been focused on stimulating the economy. It's really been, let's try and put a floor under the equity market. Now, you could say that the authorities in China are trying to sort of keep their powder dry effectively until Trump is in, until we know the full story on tariffs, and then you deliver a fiscal bazooka. But again, I'm probably in the same boat as Philip Lane. Do you really want to pin all of your hopes on that? I would say no.
The problem is we just don't know. And this is a market that there's an awful lot of questions that keep getting posed, and everybody's like, I don't know. I don't know. I don't know. We don't know what Trump's going to do. We don't know how the Chinese are going to react. We don't know how the Europeans are going to react. Trade ministers were meeting yesterday. They were talking about 10 to 20% reciprocal tariffs being applied. That's what the Commission is preparing right now. There's so much we don't know.
Such big uncertainties. I was reading yesterday about timing, though, and some people talking about second quarter of next year or second half of next year might be when we get clarity on tariffs from the US side. Michael, with that in mind and with the fact that we don't know so many things before then, we can't just do nothing until then. So what is the strategy?
Well, I think we may know a little bit earlier than that. I would be thinking sort of first 100 days of a Trump presidency is roughly when we might know a little bit more. Until then, what can you do? Because it is so uncertain. Well, I would say in the equity space, you stay in the United States because we can reasonably assume that both economic and earnings growth are going to be relatively solid there, and you steer away from Europe and from China. And you probably do a similar thing in the foreign exchange and in the fixed income space as well. You really tilt heavily towards the United States, reduce that exposure to the rest of the world, and then when we know a little bit more, perhaps it's a case of Trump's bark is worse than his bite, and then you can reallocate a little bit more to the rest of the world towards the middle of next year.
I do slightly have this theory that Donald Trump is Father Christmas, though.
And has he already been? He's been early this year.
Father Christmas has already been and gone in the form of Donald Trump and the rally that was delivered in November by the election. Are we going to get another leg to this rally?
It's a tough one. I think the bias of risks still tilts to the upside for the equity space. But what I would say is actually I think a lot of people are probably done for the year. You know, as you say, we've had that rally. We're moving into Thanksgiving next week. Then we're into December. Is anyone really going to have that much conviction at that time of year with this much uncertainty? I can't really see it, to be honest with you.
OK, we'll see what crypto does with all of that said. I mean, Nvidia earnings turn out to be the end of the year then, and then everybody goes home. Michael, thank you very much. Michael Brown, Senior Research Strategist at Pepperstone. We thank you very much for your time. Coming up on the programme, we'll get back to the French economy as French bond risk surges on budget fears. We'll talk to Pierre Muscovici. That conversation coming up shortly. This is Bloomberg.
Morning, folks. It's Friday. We've made it to Friday. This is what the European futures story looks like as we work our way towards the open in 29 minutes' time. It is exciting stuff out there. We are, though, expecting a little bit of a pop higher, which is interesting in the light of the fact that we have seen a significant lurch lower when it comes to Chinese equities overnight. The CSI is now closed, but it's closed down pretty aggressively. The Hong Kong market is down by 2.1% right now. So that's the picture we find ourselves with the markets as we continue to track, of course, what is happening with Bitcoin. But let's turn back to geopolitics and talk about what is happening there. Russia says it has launched a new kind of ballistic missile when it attacked Ukraine yesterday. It's an escalation in hostilities, certainly sending alarming signals to Kyiv's Western backers. Ollie Crook joins us now out of Berlin. What do we know?
Yeah, so listen, Guy, we got this sort of blast yesterday, and we heard from the Ukrainians it was an intercontinental ballistic missile. We heard later then from Vladimir Putin that this is a new kind of weapon, and he said that this was explicitly in response to the use of those U.S. and U.K. long-range missiles within Russia. Whether or not it's an intercontinental ballistic missile or not, what we do know is that it traveled, almost 1,000 kilometers from the Caspian Sea into Ukraine, as you can see there. We know that this is a kind of missile that can carry a nuclear warhead, and we know, obviously, it came the same week that Putin updated the sort of nuclear doctrine of Russia, really lowering the bar for what would sort of merit a nuclear response by the Russians, and also coming amid these sort of reports that we're hearing that Putin may be open to negotiations with Donald Trump. So taking the sum of all of these things, you have to ask yourself, is this a meaningful escalation for its own sake? Is it an escalation for the sake of negotiating power going into the sort of wild card of Trump? And what is the risk of one of these becoming sort of the other? We should also say we heard from the Kremlin spokesman, Dmitry Peskov, saying that Russia holds responsible positions to prevent nuclear conflict. We also understand that the United States was actually warned about this, about the launching this missile before it was launched by the Russians in the sort of nuclear de-escalation channels that still are open between the two countries. That being said, it has taken a while. It has been a while since this conflict has moved the markets, and it certainly has this week. We've seen gold move up more than 5% over the last 5 days. That's the most that we've had since really the spring of this year.
Yes, it's been a couple of years, hasn't it, since we've been quite so focused day in, day out on what's been happening in Ukraine. And thinking about the way that the West is responding to Russia here then, Ollie, meanwhile, we've heard that the US has sanctioned Russia's Gazprom bank. In amongst all of the other sanctions that we've seen applied, why is this important?
Yeah, so listen, Anna, this sort of comes as a sort of, again, one of these sort of final things potentially that Biden is trying to push through to exert additional pressure on Russia. The reason it's significant, Anna, is because we have this very strange paradox that still exists throughout this entire war, where you have Europeans paying the Russians for gas, that gas flowing through Ukraine into Europe. So this sort of strange setup where you have actually the Europeans paying the Russian war machine, the Russians paying the Ukrainians for the transit fees, and that is sort of going back into Europe. The way that they can do that is that they are still accepting payments through Gazprom Bank. We understand now that the U.S. is cutting that off. The question is whether or not this will have a sort of material impact in the market. This could put some pressure on the pricing, but the reality of the situation is everybody has been sort of prepared for this. Fossil fuels from Russia have been at the center of the discussion for these sort of last 3 years. There's also the fact that the transit agreement between Ukraine and Russia expires at the end of this year, and the additional fact that there is much more storage here in Europe. My first assignment here in Germany was going to that floating regasification unit, which is basically a boat that converts LNG into gas. That is something the Germans could not do 2 years ago. They can now do it, so it's sort of going to dull the impact. We should also say that there's probably a broader consequence here. This is potentially something that Donald Trump will be very pleased about. Last time he was president, he would consistently lambaste the Germans, saying it was totally inappropriate that they were buying so much Russian gas, and that was well before the war. He's trying to get them to buy, of course, that American-made natural gas.
Yeah, what a lot has changed. Very different geopolitical setup for the return to the White House of President Trump. Oliver, thank you very much. Bloomberg's Ollie Crook joining us there from Berlin. Let's talk about the French economy. We're going to be returning to this theme through the programme fairly often today. A gauge of French bond risk surged to its highest in a month as markets are fretting about the country's budget negotiations and a looming review of its sovereign rating. We're joined now for an exclusive interview by Pierre Muscovici, the French Court of Accounts president, and, of course, former French finance minister. Pierre, very nice to speak to you once again. Thank you so much for joining us. We were just showing a chart there of the French spread over German bond yields. So the cost of debt for France versus that of Germany, and of course France paying more than it used to. How much do you think that France should be focusing on bringing the cost of that debt down at this point?
Well, I think that we have reached such a point in our deficits and debt that there is a need for a reduction, and that it was necessary that the budget which was presented by the new government of Michel Barnier showed that we clearly, politically, wanted to get there. We have now, at the end of the year, a deficit of around 6.1% of GDP. Our debt-to-GDP ratio is 110% now, and our tendencies have been of raising that whilst our partners were diminishing deficit and debt. So there is a need for a clear impulse for a debt and deficit reduction move. The budget, the bill, which is now examined by the Parliament, goes in that direction. But it's not that easy to get there due to the fact that our political situation is not simple. The government doesn't have a majority, the parliament is fragmented, and people in France have not been accustomed to such efforts. But we need to be there. We need to make efforts, and not only this year, 2025, coming, but also for the next 5 years. And that's why the government has also sent to Brussels a strategic plan, a medium term that goes that way.
Yes.
Anybody which will govern this country tomorrow will have to do that.
We understand that the French government's budget, then, Pierre, aims to bring the deficit to 5% next year from 6.1%, which I'm told is quite a large adjustment by French standards. What impact will that have on the French economy? Can the French economy tolerate that kind of pullback?
Well, this is a big step, or a high step. This is a big effort, but it's absolutely necessary. That's a signal we must give to the markets, to Europe, that we are now on track to reduce our deficits. They are way too high. And I'm confident that we will get there. And I know that we must get there. Then it's clear that an effort of some 1.1% structurally is quite massive. It has been done in the past. When I was finance minister some 10 years ago, we did that. But it has some consequence on growth. I don't know, something like 0.2%, 0.3% of GDP. Let's say that our growth should be next year, but it also depends on the geopolitical tensions and uncertainties that you are talking about, might be around 1%. That's quite reasonable. Well, France must not be such a source of worry, since our economy is still strong. We are a very attractive country. Foreign direct investment come there. We have an attractive country by all means. And so I wouldn't be that worried about that.
Pierre, good morning. It's Guy. The question that everybody's asking themselves, though, is this budget going to pass? Is this budget going to collapse the government? It looks like the only way to get this budget through is going to be with some sort of confidence vote. What do you think happens at that point?
Well, it's hard to say. We don't know. I told you frankly, we don't have a majority in the Parliament. The government doesn't have a majority in the Parliament, so he will have to negotiate his way through a vote of confidence or a no vote of non-confidence. That would be more reasonable. I think this is still doable. And anyhow, I don't want to be too technical. We don't have time. There are ways to have a budget, even in that situation. We can have just a vote on the first part, which would authorize the government to raise taxes. That would be the revenue part. We can have also an administrative way to implement a budget. Yeah. Again, I cannot comment on a political crisis or a political difficulty. That's difficult, but I would be, but Pierre, thinking that we will make it.
Okay, you think we'll make it, but I don't know what making it looks like. We seem to be in a situation where we are doomed until the next presidential election to have a very chaotic French political story. Is the only way to resolve that to bring forward the presidential elections? Do we need clarity in France? France needs to work its way through this problem. It needs to deliver a budget. It needs to get the deficit down. It needs to deliver growth. Have we got time in France to wait for that presidential election?
You know, we are not the only country which can, from time to time, have some political difficulties. In the US, for example, you can have a president from one party and a Congress from another party, and there is no shutdown. We negotiate, we go through. You're not in the US having elections every time that there is that kind of cohabitation between two different parties. So no, we need political stability. We need to respect our institutions, and that would be terrible if we would have to call for a kind of snap presidential election. Never happened. So we need to go through these 2 years. I wouldn't say chaotic. They will be fragile, since there will not be a majority in the parliament. But again, that's the heart of muddling through. And the country is strong. Its institutions are strong. Its stability exists. So let's not worry too much. Of course, one must care about France. If I would be there in 2 weeks from now, we would be in the midst of the vote of the budget. It's not going to be simple. But our institutions are strong. This country is stable. And one must trust France.
OK, the art of the muddling through. I'm sure that's something that a lot of countries can relate to, Pierre, at these difficult times. Let me ask you about something else that is pretty unknown in 2025, and that is the impact of President Trump in the White House and his tariff plans. How do you think that France, that Europe should respond to tariffs if we assume that they are applied?
You know, I've had quite a long career, and I'm not the what-if guy. But what I know is that President Trump is going to be the next president of the US, and that the United States are our friends and allies. And whatever we think about him, and we don't have exactly the same mindset, we will have to deal with this administration and do the best possible. Then it's clear also that it might be a threat for us, as well on the environmental side, because we know that Mr. Trump is a kind of climato-skeptic. It might be also a threat for us on the geopolitical side. We could be worried about what will happen in Ukraine. We need to support Ukraine, and we're not that sure that this president and administration will do that. But also there are kind of hopes of negotiation and peace. The things are complicated there. And on the economy, obviously, a trade war is not a good thing for anybody. And if President Trump raises tariffs, we will have to examine how to respond. We cannot be naive about that.
Are you suggesting, therefore, that the right way to respond is to raise tariffs as well? There's a plan at the Commission, apparently, that we should raise tariffs here in Europe, that Europe should raise tariffs by 10 to 20%. Is that the right response? Or would there be other responses? For instance, lowering rates, bringing the currency down. Are there other ways of responding other than kind of putting our own tariffs higher?
Bringing the currency down is not usually something that we do in Europe, and it also relies on the European Central Bank, which, as you know, is independent and has to take care about macroeconomic imbalances, such as growth, but also inflation, and first and foremost inflation. So we are not yet there, but it's clear that if there is a raise in the US tariffs, you cannot expect the Europeans to say, well, that's the way it is, and have no answer. We will have an answer. We will see when President Trump is installed as president and the first moves of his administration.
Pierre, great to catch up. We genuinely appreciate all of your time this morning. Thank you very much indeed for sharing so much of it with us. Pierre Muscovici, the President of France's Court of Accounts. Thank you very much. Coming up, all eyes on Bitcoin. Where are we? 99,498. We're a little way away from 10,000. I say a little way away. It's a very little way away from that 10,000. 100,000 is the right number I should have in my head right now. We'll talk about that in more detail in a moment. This is Bloomberg.
Welcome back. This is the opening trade Friday morning, everybody. The futures picture looks fairly positive, actually, expecting to go a little higher at the start of trade this morning. Still 13 minutes until we get there. Let's talk about the markets in 3 minutes. Paul Dobson, Bloomberg's executive editor for Asia Markets, is with us this morning. Paul, let's start with crypto, shall we, and Bitcoin, because we are watching to see whether it gets to 100,000. And there seem to be a lot of reasons to be optimistic in the views of crypto investors, crypto buyers, about the outlook for crypto in the United States and a new regulatory regime. Do we have any sense of what's already priced in and how much higher this goes?
Great question, Anna. With Bitcoin, you never really know. There have been significant inflows already that have been pushing that price ever closer to 100,000. We've seen it in the ETFs this week. We also know that there's a lot of options clustered around the 100,000 level, which may be a bit of impediment in the short term to it breaching that level, but were it to punch through, you could expect perhaps there to be some added momentum behind it once it gets there as well. As you said, plenty of reasons that the market is excited and optimistic about this. We hear that Gary Gensler will be leaving. He's been seen as a sort of negative or at least a skeptic over crypto, holding it back. If there's less regulation related to crypto, then maybe the market gets more buyers and the bandwagon carries on rolling. Likewise, some excitement over the possibility of the US administration introducing some kind of crypto czar too. Things can unwind pretty rapidly as well and have big checks in crypto, as we know. But for the moment, the momentum seems pretty firmly there and people still joining in, getting hold of that rally.
Paul, the momentum in Europe and in China feels like it's moving in the opposite direction. Let's start with Europe. How grim does the picture look, and how is the data that we're going to get this morning and Christine Lagarde's speech shortly going to inform us of just how bad it is?
Yeah, you probably have a better handle on that than I do, Guy, but it certainly doesn't look all that pretty from over here. You know, the PMI's kind of just rolling along in the same kind of direction, with manufacturing still looking very depressed. Services not all that shiny either. The good news is that brings down inflation expectations, looking at five-year inflation swaps right on the ECB's target now, just above 2%. So that can encourage the ECB to keep on cutting, which will, yes, it will undercut the euro, which we've seen a lot of pressure there recently, but it should support the economy a little bit more going forwards. The other thing to keep an eye on is energy prices going into the winter, of course, and whether the Ukraine-Russia tensions there continue to ratchet up, natural gas in particular.
Yes, I note that the gas price up just 1% this morning, but a substantial rally yesterday. Paul, let's talk about China, something a little closer to where you are. The overall story from Asia was sort of flat to positive this morning, but the China story really negative. Once again, the market, just worrying about a lack of stimulus measures or a lack of detail around them?
Yeah, that's it. But where it's coming from this time is the corporate earnings, Anna. Actually, retail sales data has been picking up a little bit recently, but you wouldn't know that if you're looking at the sort of tech supermarket companies, which have had a real stinker. PDD, for example, down 10% in the US trading overnight, really feeling that pressure. And they don't have very many ideas. They're in a very competitive environment, not much more coming through. So still lots of pressure there.
Thanks, Paul. Great stuff. Paul Dobson joining us, our executive editor for Asia Markets. Single stock stories. Let's find out what's going on there. Joe Easton, over to you.
Morning, guys. So Thales is facing a corruption probe here in the UK and in France as well, related to influencing a government official and also a deal over in Asia for the French defence company. Now, Thales does say that it complies with all regulations and is cooperating with both of those probes. But we did see a drop in the ADRs, the US-listed shares of Thales last night, and we could potentially see the stock trimming some of the big gains that we've seen over the past few years as the conflicts have broken out both in Europe and the Middle East as well. That stock has doubled over the past 3 years, as we can see from the chart here, so one to watch over in Paris today. Then in terms of banks, we've had news from Spain of an increase in the windfall levy to around 7% from below 5%. And this has spurred a furious backlash from some of the banking unions over in Spain. Here's their statement saying they denounce the legal uncertainty and serious economic effects of a tax that has been created in a chaotic and non-transparent process, according to a joint statement from both of the banking associations there. Now, this applies to banks with annual revenue above €5 billion a year, so potentially it's going to have more of an impact on the likes of Santander and BBVA than it would on some of the smaller lenders on the screen here. The smaller ones potentially have actually seen bigger gains this year than the bigger names, but we're going to be keeping an eye on all of those stocks nonetheless today. Then in terms of retail, potentially we're going to be looking at apparel stocks as well. Gap in the US soared last night around 16% as the retailer upgraded its sales forecast for the year and also lifted its margin view as well, not just related to the core Gap brand but also Old Navy, the other big brand, doing as well. There's that massive rally in the post-market trading for that one. The ones to watch in Europe today will be Inditex, H&M and the Primark owner AB Foods. Inditex, the Zara owner, the really big outperformer this year. The only footnote is that Gap's exposure to Europe at the moment is pretty small, given they closed a lot of their stores here in the UK and around Europe recently, but potentially there might be a bit of a read on the broader sentiment for that space. Then in terms of ratings, Citi says that a capitulation in the share price of Porsche P911 recently means that you should be adding to your holdings. It's a good chance to buy that one. JD Sports is cut to neutral at JP Morgan after falling 15% yesterday. And over in insurance, Morgan Stanley changes its preference on the Dutch names, liking Aegon, which is an overweight over in Amsterdam this morning.
OK, thanks very much, Joe. Yeah, increasing in your stake in Porsche might be cheaper than buying a Porsche, so thank you very much for that. Joe Easton with the latest on stocks in focus. As we head towards the open then, Guy, I've got one eye on what's going on some of these commodity markets, but not a huge amount, frankly. The gas price up a little bit, but that really reflecting tensions that have been building day after day, and the cold weather, in case anyone hadn't noticed, certainly arrived here in Europe. Iron ore prices on the back foot just a little bit, so a fairly mixed picture when it comes to commodities, and that can push London around a little.
I hear it gets wetter and warmer and windier tomorrow, so maybe we'll see this being reasonably short-lived. We'll see whether the gas price comes down on Monday. Certainly a story to watch, though, as we watch it feed through into the wider economic story. We're going to get PMI data in the next hour. We're going to hear from Christine Lagarde in the next hour. And, of course, we're going to be getting the opening trade. That is what we're building up to next. Futures are pointing a little positive. More to follow in just a moment. There's the story, as you can see. We're up by a little bit. It doesn't feel like it's kind of anything to do with Europe this morning. This feels like a drag higher, maybe generated out of the United States. Anyway, we'll look at the open in a moment. The opening trade is coming. This is Bloomberg. Friday morning, good morning. I misspoke a moment ago talking about the fact that maybe actually the steer coming out of the United States is enough to drive Europe higher this morning. Futures are higher, but it doesn't appear to be generated from this chart here. That's the US close. I don't think there's really anything in that tells us why Europe should be higher this morning. So there are maybe other reasons why Europe is higher this morning. But generally, I think after being beaten up quite so badly, maybe that's a factor. You're looking at the currency story to fold in as well. Maybe there's a little bit of corporate news which is going to lift us as well. But as you can see, we are higher. The CAC is up, the FTSE's up, the Euro Stoxx 50 futures are up by, let's call it circa 0.5%, pretty much consistently across the board. So that's the narrative that we are watching this morning. Nice to see some green on the screen here in Europe. It feels like we have been missing that maybe for quite some time. But actually, this isn't where the action is this morning. We're watching Bitcoin. We're trying to figure out what's happening there. And the other story I want to fold in as well, just keep it on your radar, is what happened in China overnight. Really ugly session, Anna, in terms of what we got there in terms of the stock story. The CSI down over 3%.
Yes, and that seems to be, as we were hearing from Paul, seems to be very much driven by the corporate story in China itself, also the tariff expectations, that constantly in the mix now when it comes to China with the new Trump administration waiting in the wings. Yields in Europe down a little this morning, just adding that into the mix of things we're watching, but not really by much. In terms of the individual stocks we watch, then Thales is in focus. Could we see that one dropping? We've got that after-hours news stateside of a legal nature, and this is a stock that has been, as Joe told us earlier, up threefold in 3 years, so a lot of focus there. The Spanish banking sector increasing taxes there, so we'll watch out for that sector, the sector pushing back against that increase in tax. And Gap, we've got numbers there that pushed that share price up 13% after hours. Could we have a read across into apparel stocks, Guy?
We will watch with interest. We're about to find out. The Friday session is almost upon us. Here we go. It's time for the opening trade. These are the numbers that we are looking at. Remember, we've had disappointing retail sales data out of the UK as well, so the pound's a little softer, but not by much this morning. So the FTSE 100 rises. I'm not sure it's actually maybe got anything to do with the pound, but it's up by 0.3%. The FTSE 100 trading at 81.73. The Stock 600 is up by a similar amount this morning. We are rising there. The IBEX is up by a similar amount. Recently, we've been seeing very flat markets, so a little bit of a lift coming through here in Europe. The CAC DAX maybe got a little bit more to digest. The DAX a little less so, but the DAX, the SMI and the CAC remain close for the time being. We will bring you those numbers in a moment, Anna.
Yeah, really interesting dynamics happening in the Asia session and the extent to which they're passing through or not into Europe. We talked about the weakness in China, and that certainly has been a feature, particularly the latter half of the trading day over in China. But in terms of what that means for Europe, elsewhere we saw the Asian tech story looking quite positive, and some of that was to do with what we'd heard out of Nvidia and the fact that Nvidia ended in positive territory yesterday. So with all of that in mind, that's my long way of getting to the fact, Guy, that we've got technology stocks doing pretty well this morning. So technology up by 0.8%, and we've got some of the usual names within the tech space doing okay. So Infineon, ST Micro, ASML, all moving higher. Media also moving a little higher this morning. Informa and Universal Music Group, those kind of businesses moving higher. In fact, all sectors are in positive territory. So even though the driver of this slight positivity we're seeing in Europe, it remains a little elusive, it is having a bit of an impact this morning, Guy, on markets. We are higher across all of the sectors. Technology up by 0.8%.
Yeah. Thales appears to be the reason why the CAC 40 is not open yet. I don't see a price on that, so that is why we're not getting the French market delivering an opening. Every other stock, it seems, that we are seeing within the CAC 40 is open this morning. In terms of where the weight is elsewhere, technology seems to be up a little bit more than most, but as you say, there's no clear sense of direction in terms of what is happening here. So you've got ASML, SAP, AstraZeneca, LVMH and Roche, Novartis, the main gainers in terms of the point story.
Yeah, it's been really interesting the last few days where the trading session for Europe in the morning seems to have been undermined by geopolitics. On a number of days, that's been the story. And then we've turned things around in the US session a little bit later, where the market has focused in on maybe some of the tech stories or some of the earnings stories instead. And today we don't have that geopolitical concern, so it seems to set today apart from what we've seen the rest of the week.
I think we probably do have the geopolitical concern. We just haven't any new news on it.
Exactly.
To terrify us into maybe taking action when it comes to what is happening with these stock markets. Goldman Sachs cutting its expectation for the stock 600 earlier this week, citing tepid economic backdrops across the continent, modest profit growth and share valuations close to their long-term average. European stocks have, of course, retreated since Donald Trump's presidential win, while the euro has skidded towards parity. We're not quite at parity yet. We're kind of 104. We're below 105, which I think is a significant line in the sand. Beata Manthi is head of European equity strategy at Citi. How are you feeling about European stocks right now?
Good morning. Well, Europe has been definitely in the epicenter of the storm for quite some time, right? So I see huge amount of bearishness and negative sentiment, both from the analysts' forecast perspective, recessionary level of downgrades that really doesn't happen outside recessions. And that has happened because underneath the surface, many sectors, many cyclical sectors, tech, luxury goods, autos, commodities, have had meaningful 20 to 30% cuts to their EPS growth for this and next year. So, of course, the market has been underperforming. Then we got Trump win. It was the most obvious, the easiest negative Trump trade, just to add a bit more to the negativity. And what it resulted with is the most bearish relative futures positioning on Europe versus the US since actually 2018, when the first broader trade tensions erupted during the first Trump presidency. So this is where we are. Okay. Everybody's negative. Nobody wants to touch it. And the question is, what's going to happen next? And that's, of course, reflected in the underperformance of the index overall. And underneath the surface, even more on particular sectors, right? So that's the setup.
And are there things that have been oversold in that context then, Beata? Because, I mean, people might be attaching that discount to the whole continent, but not all of the stocks listed within the continent are equally exposed to it and its economic fortune. So I wonder if things have been oversold.
So oversold, perhaps it's a big word. Within some individual names, I can't comment on absolutely. On the overall index level, on the relative basis, you see this gap opening up, like we have this what's priced in for EPS model.
But are there themes that maybe could look through
Anna really wants
negativity? I'm really trying. It's Friday.
I'm all about the silver lining.
It's Friday and I'm dressed like a Christmas tree.
Let me tell you.
This is the positivity I'm channeling.
So from the negativity, I've mentioned these earnings revisions, the recessionary level of earnings revisions. Our model suggests that historically there is a bad and good news attached to this recessionary level of reading. The bad news is that next year's EPS, consensus analyst EPS, is probably too high. So analysts are at +8, had +10 not so long ago. We have +5, so meaningfully lower. But the good news is that at this point of negativity, the market starts to see through this earnings weakness that has been already ongoing for quite some time in Europe. In the short term, not necessarily, like 3 months is a coin flip, but over 6 to 12 months' time, our model suggests that cyclicals tend to outperform defensives by on average 10%. So there could be better times ahead, but of course there are many moving pieces
The problem with the European story is that we keep thinking that all the bad news is in, and then we get more of it.
Absolutely, but we've already got a lot of bad news,
Sure,
right?
but it keeps coming.
Sure. At this level, you could assume that going forward, the news, the balance
Could I have
of
made
risk,
that argument 12 months ago, though?
12 months ago, the news was getting better. So no, you couldn't. Because everything has been improving, right? And there is a bit of deja vu from last year. That's a good one, right? So everything looked gloomy. PMIs were dipping. And historically, when PMIs dip, we only know it with the hindsight, but that's, again, over the 6 to 12 months horizon, it is a good time to start averaging into cyclicality. So what we've done with our allocation from being in defensives and bearish over the summer came mid-September, we've started to average into cyclicality. We still have a bit of a barbell, but that's been the right way forward. So at least you need to close your shorts of the most underperforming parts of the market.
But how do you go about factoring in tariffs? And I'm thinking here about Trump's tariffs that people expect and the timing of those and the reaction that we are likely to see from Europe. How do you go about factoring in all of that?
So every single question you've asked about that concept is very difficult. There are many unknowns to answer it properly, right? So the timing, we won't know details for the next good few months, right? That's number one. Then how they are going to be applied. Is it going to be broad-based 10? The consensus is it's going to be difficult, right? Because if you really, being the US, if you put tariffs on everybody around the world, your economy is going to suffer from multiple shocks, while all the other parts that you put tariffs on, because there will be retaliation, right? Will get a shock, but lower shock, right? So, if anything, the US economy has more to lose from an open trade war with the rest of the world than the European one. But just to put things in numbers into context, our economists estimate that for the Eurozone overall, perhaps 20 basis points of the GDP. Germany could have a little bit more, of course. So this is where we are. Of course, there'll be impact, but it's not going to be cutting off 1 to 2%, right? We are talking basis points.
Anna brings up Christmas, so let's talk a little bit more about Christmas. Is Donald Trump Santa Claus? Because the Christmas rally appears to have already been and gone. Is that it? Is Santa come early in the guise of Donald Trump?
Well, the Santa just came for the US, right?
Yeah.
I can't say that Santa came for the European market.
What are we going to get in Europe? So we talk about coal maybe in historical context.
So let's see if this bearishness of the sentiment, positioning and everything around us actually starts seeing improvements on particular parts. And it could come from many places, more from China, a lot of negativity and doubt that this will come. A lot more from administration and who is going to put in charge of the important polls and saying actually the 10% is negotiable. But also more news flow from the European Union level in terms of what they are going to do to prop up the economy, right? The ECB has already turned to the economy favor. We thought they would go cutting every quarter next year. Now we think they will go at every single meeting to around September. So you're already starting to have more positivity there. Well, let's see what comes with PMIs. Of course, they are expected to be very low. But what I've noticed, they are low, of course. But the last 2 months, they kept beating expectations, right?
Okay.
So that's what the market notices.
We will look to see if we get that silver lining. We're going to get those French PMIs in around 5 minutes' time, aren't we? And then the German ones in around 20 minutes. You mentioned China, so just to linger on that, Beata, is that something that could provide a cyclical uplift for Europe? Or is this more of a... Are we structurally going to witness a different relationship between China and Europe?
So... Again, many moving parts there, right? From the economic perspective, it's more obvious that there will be tariffs on China than there will be broader tariffs from the rest of the world. And tariffs on China will have a negative GDP impact on China. So we need to see what is the response function going to be from China. So we think that on Eurozone GDP, the squeeze on China via tariffs could have an additional 10 basis points negative impact on the GDP. Now, in terms of EPS, it's a bit different story, right? Because the biggest downgrades and cuts to EPS this year have come through sectors and names with the biggest exposure to China. So what we need to start first is positive deltas from very low levels. And this is plausible to imagine.
Stock 600... 505 right now. That's where it's trading. Where do you think it finishes next year? Up or down?
With what we have right now, my forecast suggests up. I don't have the year-end forecast for next year yet.
That's what I'm hoping you were just going to kind of give us a little hint at.
The direction.
You think
up.
higher?
The question is the
magnitude.
How much, yes, and it could be volatile, right?
Yep. We're going into a Trump presidency. I think volatility is probably assumed at this point. It's always nice to see you. Thank you very much indeed. We'll look forward to your year-end forecast. I'm sure it will be coming shortly. Beata Manthi, Head of European Equity Strategy, joining us from Citi. The Core 6 looks like this. This is how we are trading this morning. Europe's actually reasonably on the front foot this morning. Actually, some positive numbers are being posted. ASML in particular, as you can see, rising quite nicely. Thales is under a little bit of pressure. It's not on this board, but it is under a little bit of pressure. Let's get some details as to what is happening, more specifically in the French market. Here's Joe.
So we've got another mover over in France today. This is Nexans. This is the big French energy company. We got a book building on this, a share sale last night after the close of trading. And it is actually Chile's richest family selling a big stake in this stock, according to our reporters. They're selling around $250 million worth when converted into dollars. It's the Luxic family over in Chile offloading some of those shares after a big rally in the stock over in France for that one. Then we will switch over and look at that move that we had in Thales. It was a delayed open on that one. We saw a bit of a trading halt into the open in Paris. We've got that price now down 4%, facing a corruption probe in both the UK and France. Bear in mind, they do say they are complying with the probe and do stick to all regulations, but it relates to a deal over in Asia and potentially influencing a public official, is a statement from the UK and French authorities on that one. Then in terms of the Spanish banks, a bit of a mixed view on these ones today. Pretty much unchanged on Santander, BBVA slightly higher, and not too much action in the others. Remember, Spain raising its windfall levy up to 7% from below 5%, but some of that broke just at the cusp of trading yesterday, and we haven't got too much reaction yet, so we'll keep an eye on those. Over in apparel, remember Gap soaring around 16%. I'm still gutted they closed all their UK stores for Gap. I used to love shopping in there, but anyway, we have got H&M gaining a bit, potentially a bit of a move on that one. Inditex up 0.7%. They do have US exposure. GlaxoSmithKline, meanwhile, has a vaccine approved over in Japan for respiratory viruses. That's between people aged 50 and 59. It was already sold to people over 60. So that's a positive for GlaxoSmithKline's earnings for them. And then finally, the rating that got me exciting today was Porsche, because Citi saying you should be buying this stock after a 10% drop in the past 4 days as the company held meetings with investors, which spurred downgrades to earnings guidance. €85 price target, Porsche edging very slightly higher today.
Thank you very much. Joe Easton joining us there with a look at some of those stocks that are on the move. We are waiting for the French data then, French PMI data due out, Guy, and we were just hearing from Beata Manthi. You know, if you're looking, she was hoping that we might see a similar pattern to previously, where these numbers have beaten expectations, even if they're at low levels, but we'll have to see if that's what we get. We are expecting all of these numbers to start with a 4, and they still do. So let's go through these. We've got the composite number has come in at 44.8. That is well below the 48.3 expected. The services number has really dropped. That is down at 45.7 against an expectation of 49, and the manufacturing picture still bumps along the bottom at 43. That, again, is below the expectation of 44. So we have not got numbers that have beaten expectation. We have got numbers that have come in weaker, and they signify contraction. They're all below 50, continue to be below 50, and increasingly so. And the euro responds negatively as a result, Guy.
Shocker. Those are really horrible numbers. Those are really, really horrible numbers. But given the political instability that we are seeing, I guess maybe against that backdrop, you would maybe expect this. We've got a budget that we're factoring into our thinking. All of that is coming through. So we need to begin that process. In terms of what we are looking at, I'll get the commentary up in just a moment once I've cleared the website's guidance and see what exactly is coming through from the release in a little bit more detail around it. But there's a lot of negativity here. This is not a beat.
Right. Then let's bring in somebody who knows these numbers inside out. Bloomberg's Zoe Schneeweiss joins us here on set and can take us through. I mean, they look horrible, Zoe. What more do we need to know?
Yes, these are quite atrocious numbers. If you remember, France in the summer did actually surprisingly well, and that was all thanks to services, thanks to those Olympic Games and Paralympic Games that did so incredibly well, and France had a great third quarter. We always knew the fourth quarter was going to be painful, but these numbers just do give you an idea how painful it might be, and services has been that area throughout Europe that is manufacturing has been bad for years now, but the services have always saved it, and it looks like services no longer giving that support.
Yeah, and we're waiting for the German number, and services has been an area of brightness there. But this suggests, in France at least, that we've seen a real deterioration on that story. Is this about geopolitical uncertainty, or do we have a sense of what this is about?
That certainly plays into it. We obviously have there's uncertainty over the whole situation in France itself. You mentioned the budget. They know Macron's Prime Minister Barnier does not have a majority in Parliament. Yeah. That is an issue. Overall, though, this is just one of those things. If then the geopolitics play in, we all know that Trump tariffs will likely come and will just be detrimental for Europe.
And we come back to this question of whether or not France can wait. Germany has decided it's going to go early on its elections. Can France really wait and have another 2 years, 18 months of this kind of political instability that we're seeing at the moment? This is the line that comes out of the statement. The level of incoming new work received by private sector businesses in France slipped deeper into decline in November. New orders shrank by the greatest margin in exactly 4 years amid a broad-based deterioration in sales performances at the industry level. These are the worst numbers in a really long time.
Yeah.
The situation is not improving in any shape or form in terms of this data.
And the French government wants a better French economy so that it can deliver on some of the tough choices that it needs to make. But is there a danger that the tough choices around the budget and around pullback in spending, is that a factor here, Zoe?
Any element of uncertainty is harmful for companies. They're missing investment. There is this whole idea that Europe should be investing more, and there actually was a joint op-ed from the French and German central bank chiefs in Frankfurter Allgemeine Zeitung and Le Monde overnight, where they said Europe needs to get its act together, but governments just seem to be thinking quite nationally focused and not on how a joint Europe program could actually help all of them.
Yeah, what they're not saying is more debt. What they're saying is structural reform is required. We need less red tape. We need more investment. We need those kinds of things to get Europe going. French companies anticipate the contraction trend in activity to carry on to 2025. For the first time since 2020, May 20, expectations for output level in the next 12 months were pessimistic. The outlook is getting worse here in Europe. Am I correct in the kind of feeling in trying to aggregate all of what we're learning in Europe at the moment, that actually we're not stabilising at a low level, we're continuing to deteriorate?
That's very much the case, and that's the one thing the ECB also is worried about, because if the growth deteriorates too much, that will obviously impact inflation, and there's the danger here that inflation then actually quite severely undershoots the ECB's 2% target, and that's something we'll be watching when Christine Lagarde starts speaking in about 10 minutes.
Yes, she's going to be speaking very soon, isn't she? And we...
I think she's actually speaking now.
Well, let's wait and see. Oh, she's welcoming people, I think, so we'll see what we get from her. I mean, 50? This was the conversation yesterday. We had various central bank governors speaking yesterday, and maybe the cuts are going to come faster than the market had expected, or maybe they come bigger than the market expected. Zoe, what are we hearing?
That's the issue. Most of them, and even like a quite dovish governing council member like Yanis Stounaras, who was on Bloomberg TV yesterday, was saying his base case is 25. Obviously, if there's a deterioration in growth, they might recalibrate. It'll be interesting to see how the German and then the euro area numbers for PMI numbers that come out later will affect
the sense is, though, and someone to a certain extent reflecting this as well, is that there's so much we don't know.
Yes.
We don't know at this point what Trump is going to deliver. We don't know what the response out of the European Commission is going to look like. We don't know so much, so therefore the potential for a policy mistake at this point, say it were to be 50, is greater. Is the ECB therefore hemmed in at this moment, constrained in its ability to act because of the uncertainties that exist at the moment? Those tariffs, that tariff narrative could be inflationary. The ECB just doesn't know at this point.
You're very right there. There is the issue that until Trump's in office, I wouldn't expect any change from that 25 basis point cutting pace that the ECB has put on display. I am curious, though, how markets are repricing after these French data, and we'll see what the German and euro area
the
data
euro's
deliver.
dropped, but it stopped dropping. It's still in positive territory, so maybe it's waiting for the German data as well. We'll see.
And then the Eurozone data, which comes a little bit later on as well. Christine Lagarde is speaking. Let's take a listen to what she has to say.
To free trade from all corners of the world. And as the most open of the major economies, Europe, we are more exposed to those trends than many others. I will call Capital Market Union from there on CMU, so it will spare you a little bit of my repetitive anthem. CMU lies exactly at the center of all these challenges, in my view. And it is key for making our economy more dynamic and technologically advanced. While banks, you, play an essential role in the European economy, we know that integrated capital markets are needed for financing, in particular, early-stage breakthrough innovation. And it is key for becoming more resilient in a fragmenting world economy. Capital markets, in our view, is the missing link for Europeans to turn their high savings, more on that later, into greater wealth, which will ultimately enable them to spend more and strengthen internal demand. My macro is coming back here. However, this growing urgency has not been matched with tangible progress towards CMU, in large part because its implementation remained very loosely defined. Since 2015, when we first started seriously talking about CMU, since 2015, there have been more than 55 regulatory proposals and no less than 50 non-legislative initiatives. But that breadth has come at the expense of depth. It has allowed CMU to be picked apart by national vested interests that see one or another initiative as a threat to their territory and some of their mandates. So if we are to achieve a conscience shift, in my view, we need to refocus. Exposing the core inefficiencies in the system, yes, and identifying a smaller number of initiatives with the highest possible return. And as I see it, the core problem of CMU is that the pipeline from savers to innovators is blocked at least at 3 key stages. And that's the reason why I called my speech, Follow the Money. I know it resonates with other things, but this is literally. So those 3 key stages are, number 1, entering, number 2, expanding, number 3, exiting. What do I mean by that? First, European savings are not entering capital markets in sufficient volumes because they are concentrated in low-yielding deposits. I'll come to those 3 in a moment, specifically. Second, when savings eventually reach the capital markets, they remain trapped in national silos, and they're not expanding throughout the European community. Third, once savings have eventually been allocated by capital markets, they are not exiting towards innovative companies and sectors owing to an underdeveloped system for venture capital. So there are three blockages, bottlenecks, if you will, that require different solutions, but they must be seen as a single problem because they are self-reinforcing. Fewer high-growth companies means lower equity valuations and liquidity in the European Union markets, and lower returns for savers. So in my remarks this morning, I will outline the key blockages I see in each area and present some proposals with great humility, because I'm sure that there are other ideas and proposals that are out there, and maybe they're much better than mine. But I think it's about time that we actually put chips on the table and consider them, rather than just have general views about the shortage that we have here in Europe. So let's talk first about entering the capital markets. Europeans have a high share of their income, about 13%, high share of that income is actually saved. And this is much more than the Americans. In 23, we, the Europeans, we saved about 13% of that income, when the Americans were saving 8%. That's in 23, and that's pretty much a standard trend. But typically, Europeans favor low-risk, liquid-saving products. In Europe, approximately 11.5 trillion is held in cash and deposits. I'm talking here about the stock. This is 1/3 of households' total financial assets. If you compare that with the United States situation, it's 10% for the US. So that has two main consequences for our economy. One, European households are much less wealthy than they could be. Since 2009, post-financial crisis, US household wealth has grown by around 3 times more than that of the European Union households. 3 times. Now, some of you will dissect that and will say, oh, it's all about some of the Magnificent Seven in which American households eventually have invested, and as a result of that, we have the difference. Not only. Second consequence, the flow of savings into capital markets is much lower than it could be. According to our analysis, if European households were to align their deposit to financial assets ratio with that of American households, a stock of up to 8 trillion euros could be redirected into long-term market-based investments, that's in stock, or a flow of 350 billion euros per year. So why are people not diversifying their assets? You probably have ideas about it, but I'll propose mine. One of the key issues is that retail investment in Europe is fragmented, opaque, and expensive. In many countries, investing is complex and intermediated by financial advisors that people do not always trust. 45% of consumers say that they are not confident that the advice they receive is primarily in their best interest. And if households do invest, they often do not get the best deal. Retail investors in Europe, in mutual funds, for example, pay almost 60% more in fees than their US counterparts. Many Europeans, therefore, end up investing in guaranteed saving accounts by default. But this is not in the DNA of Europeans, because they would be more risk-averse. No. Because when markets are a bit more competitive and consumers can choose from a wide range of suitable investment products, behaviors do change. In the Netherlands, in Sweden, in Denmark, households manage their assets in a similar way to that of their US counterparts, holding only about 10 to 20% of their financial assets in liquid form. So if we are to unblock the entry stage of the pipeline, we need savers in Europe who have products that are accessible, transparent, and affordable. In my view, a European saving standard, a standardized EU-wide set of saving products, if you will, is one way and maybe a good way to achieve these goals. Without adding to the bureaucracy, I get that. But if properly designed and distributed, these products would be accessible, simple to understand, available everywhere, and offering a range of investment options. They should be transparent, because they would be structured according to clear criteria, such as diversification, fee structure, and portfolio composition. And they should be affordable, because financial services providers would be able to offer EU-certified products with less red tape, while standardization would lead to more comparability and probably more competition. Both effects would probably bring down the fees. The attractiveness of the European standard should also be enhanced by harmonizing tax incentives across countries. And this does not belong to your community, it belongs to policymakers, and they should not be shy about that. They should be courageous. Then the market should decide where savings are directed, not the governments. But depending on the preference of savers, products could also be offered that would support European priorities, such as financing innovation and the green transition. That's for the entering into the market. Let's just now look at the expanding throughout Europe. Because to truly unlock Europe's innovative potential, which exists, we need finance to flow where the best ideas are. And given the nature of digital technology and the impact that it will have, which often requires large upfront investment, we need those flows to be in large volumes. And the second stage of the pipeline, expanding throughout Europe, is also blocked. Second bottleneck. We observe that capital in Europe is either trapped within national borders or leaves to the United States. If we look at equities, for instance, more than 60% of households' investment in Europe takes place within their own country. And if you look at institutional investors, they invest much more in US markets than they do in the European Union. There are many reasons for this segmentation of European markets, but a key one is that our financial market infrastructure are extraordinarily fragmented. In 2023, bear with me, I'm not making a mistake on the number. In 2023, there were 295 trading venues in the European Union. 295. There were 14 central counterparties and 32 central securities depositories. I was going to bring a slide, but it's not done for the president of the ECB, so I did not. But I have a drawing that I will frame in the hope that within a few years it is a little less artistic. And that drawing includes the 295 and the 14 and the 32. And it makes for a beautiful drawing, but not a very simple sector to navigate. In the United States, there are only 2 securities clearing houses and 1 CSD. Now, many CCPs and CSDs belong to pan-European cross-border groups, but national exchanges remain largely separate, despite some technical synergies like consolidated order books. This fragmentation creates high transaction costs for cross-border trading, which, according to ECB analysis, increases home bias in how investors allocate their funds. That, in turn, leads to lower liquidity for investors, issuers, and stock exchanges. Compared with their EU counterparts, the average daily trading volume per company is 1.3 times higher for US large caps and 2 times higher for US mid caps. So, what is driving this fragmentation? Again, you will have ideas and views on this, but let me put out mine. The main issue is that legal frameworks within the EU are divergent, and all meaningful attempts at harmonizing are blocked again by vested interests, often of a national nature. And national authorities tend to exacerbate rather than reduce this problem. For instance, there are some member states that mandate the use of national CSDs for issuing securities under national law or for settling primary issuances of sovereign funds. This mélange of different regimes and enforcing parties severely limits the ability of exchanges and CSDs to integrate their national platforms, even within cross-border groups. Although I know that there are some movements in that area, and I applaud them. Progress is being made, yes. Europe is moving towards a common consolidated tape, which will help reduce transaction cost. This tape could reduce trading costs by about 40 to 60% by increasing transparency between dealers and investors. But it will not address the fundamental problem, which is that our incremental approach focused on harmonizing a multitude of national law of different categories, which involve different ministries in different settings, simply either doesn't work or works way too slowly. Again, looking at the other side of the pond in the United States, legal convergence often does not come about through total harmonization of state-level laws, but rather through federal law being introduced or one state's law becoming dominant. For example, almost 80% of all US companies that held an initial public offering in 2022 were incorporated where? In Delaware. You know that. In Europe, we will not be able to make progress by promoting one country's legal system over another. And that is why I called for a European SEC in my speech last year, and I reiterate, and I believe very much that it could be transformative, and it could well be organized as a network of offices throughout the member states. We can be creative in that respect. But there are two main ways that we could achieve a change in method. Because alongside this goal, there are other options to pursue. It does not detract from the fact that a European SEC is a move forward that I believe will trigger a lot more. Because supervision moves initiatives. So one of those two other options would be to adopt a two-tier approach, as we have for competition enforcement in Europe, or for banking supervision, as you know well, with the SSM. Entities that meet certain criteria would automatically fall under EU jurisdiction and within a common Europe-wide legal framework, with cross-fertilization of the legal systems under the authority of one key entity. Another option would be to use the 28th regime, much talked about in both the Draghi and the Letta report. That could enable us to carve out a special legal framework in areas where progress has stalled. We would then have a separate EU legal regime that firms can opt into, sitting alongside the various national regimes. In my view, the most realistic approach probably involves some combination of all that I have just mentioned. For example, to bypass the cumbersome process of regulatory harmonization, we could envisage that 28th regime for issuers of securities. They would benefit from a unified corporate and securities law, facilitating cross-border placement, holding and settlement. But such a regime, as attractive as it sounds and as a bit of a cop-out from the difficulty of harmonization, would, in my view, be unlikely to work for supervision, as it could lead to inconsistent enforcement and misaligned incentives if entities choose their own supervisors under an opting-in system. So here, we could envisage a two-tier approach or a single but decentralized approach. Financial services providers that fulfill a set of criteria, such as size or cross-border activity, would fall under European supervision. A shift that I called for at this event last year, remember. National authorities would continue to supervise smaller national players. Close collaboration between the European securities and market authorities and national authorities would be essential for success and would maybe move us further, because this is not going to happen overnight. So much for expanding. Let's look at the exiting, and that will be my third and last set of propositions. Because even if we get capital moving more freely within Europe, we still need to ensure that it exits the financial system into innovative sectors and companies. That's the whole point. And this is the third stage of the pipeline, which is currently blocked as well. In highly innovative economies, there is typically an ecosystem of investors, angel investors, well, let's start with the family, but it's then angel investors, venture capitalists, private equity funds. And that ecosystem channels funds to high-growth startups, mostly through providing equity. And this ecosystem is much less developed in Europe than it is in the United States. VC investment is only around 1/3 of US levels of venture capital. The upshot is that innovative young firms struggle to grow in Europe, especially once they reach the scale-up phase, where larger funding rounds are needed. The median European VC-backed company receives around half as much funding as its US counterpart in the same sector of activity. And we are largely reliant on foreign venture capital to fund European innovation. More than 50%, 50, of late-stage investment in European tech comes from outside the European Union. Something wrong with that? No, we welcome, as an open economy, investment from all parts of the world. But if the EU tech entrepreneurs, and we have many of those, receive mostly outside funding, it creates an ecosystem of its own. It creates a path dependency. And these founders may ultimately decide to list and grow their businesses elsewhere, particularly in the US market. And this is what I would call the unintended exit. So what can we do to close that financing gap? Let me look at it from a demand and supply perspective. Fixing the demand side is key. There are too many barriers and bureaucratic hurdles for entrepreneurs in our single market, which means that there are fewer high-growth companies and VCs that want to finance them. If you look at the Letta or Draghi report on completion of the single market and improvement of our competitiveness, it is obvious and full of very, very clear examples. But we also need to work on the supply side. And since we are starting from a deficit position, we need to use all the flexibility we have within the European financial system to unlock funding for innovation. Let me propose 3 changes that could make a difference. I'll be short for each of the 3. First, given the natural alignment of investment horizon, our regulatory regime should allow long-term investors to contribute more to long-term growth. For example, European Union pension funds allocate just 0.02% of total assets to venture capitalists, compared with almost 2%, so 0.02 for us, 2% for US pension funds. And this percentage, don't forget, is applied to a much larger base in the United States. Over 140% of US GDP compared with around 30% of European GDP. First proposition. Second, we should fully harness the potential of our public development banks, especially the European Investment Bank, to pool risks and crowd in private capital. Not cried out, cried in. Successful initiatives are already afoot. Last year, the European Investment Bank and 6 member states launched the European Tech Champions Initiative, a fund of funds aimed at channeling late-stage growth capital to promising European innovators. To date, the fund has mobilized 10 billion euros in public and private resources and supported 16 tech scale-ups. This is significant, considering that in 2023, European scale-ups received around 30 billion in venture capital. So a third. But more can be done to unlock the EIB's potential and enable us to catch up with our peers faster. In particular, the EIB should be allowed to use its resources more effectively and provide a wider variety of instruments to support breakthrough innovation, especially when it comes to supporting early-stage startups. I welcome those changes if they happen. Third proposal, we should explore how to support innovation not only through equity, but also through debt. While Europe should ultimately aspire to have quasi-US levels of VC investment, in the meantime, because it will not happen overnight, we need to make the most of our solid, reliable, bank-based system. Banks can play an even better role in financing innovation. One interesting development in Europe over the past decade that you have instrumented has been the rise of venture debt. Venture debt loans that provide liquidity to startups between equity funding rounds. In 2022, around 24 billion euros in venture debt was allocated. And that is up from only
ECB
1
President Christine
billion
Lagarde speaking at the European Banking Congress in Frankfurt, talking a lot about Capital Markets Union. We will return to that theme in just a moment. But whilst she has been speaking, we've been dealing with some German news flow. We covered the French PMI data some half an hour ago. And then whilst she was speaking, we got the German data. Zoe Schneeweiss very kindly stayed with us to cover this. So let's get to that. Zoe, your thoughts on what we're hearing out of Germany then. So the French numbers came as quite a negative surprise for markets. They were very much into contraction territory. The bad news for Germany is that services, which had been a bright spot, now back below 50.
Yeah, that German number, that German services number is quite horrible. If you look at the longer data, services had been growing every month since March, and the last time it contracted was February. So now being back in contraction for services, which has been the one thing that has been saving Germany. As we know, Germany is very much a country about manufacturing. It's a strong export country. So the malaise that we've seen there, that manufacturing malaise, has been one of those haunting topics all year. And services has always been the area that saved them. So this is very bad news. And if I think about the election campaign that's going on right there, this is just one of those things that, again, will probably hurt the current government and, again, help the opposition and maybe those fringe parties.
Let me throw another fly in the ointment. The German data are bad, but the inflation number within it also is very bad as well, once you start digging into the details. Inflation is ticking high. It's being driven by services, but it's input and output. We're seeing effectively a very clear demonstration of a stagflationary services sector economy in Germany. It's not producing the growth. We can see that at the headline number. But you've also got an inflationary tick higher, which is presumably going to concern the Bundesbank.
That will concern the Bundesbank. The Bundesbank is generally, if you think of it, Joachim Nagel, the Bundesbank chief, he regularly refers to inflation as the hungry beast. And he said actually earlier this month that hungry beast finally had been defeated. So these numbers will concern them. It does help explain, though, why the Bundesbank always takes such a hawkish stance. If inflation is, in fact, an issue in Germany, it's a reason to go slower maybe on those rate cuts. At the same time, if the growth is so bad, really that needs to feed through to inflation.
And the market has been pricing in more cuts as we've been digesting this data this morning, or at least yields coming down.
So yields have come down. We've got a 35 basis points now priced for December, i.e. we are above 25. So the market's beginning to put 50 on the table. We're not there yet, but we're creeping in that direction, which I think is interesting because most of the central bankers I'm speaking to, we're hearing from, are saying we need to be cautious.
Exactly. The number they're waiting for is next week's inflation number.
Yep.
We get inflation data for November on Thursday, Friday next week, and those will be the numbers that probably let the ECB decide in the end.
Sorry, thank you very much indeed. Zoe Schneeweiss talking us through what's happening in terms of the data, and Christine Lagarde, who is still speaking, still on live go, if you want to watch her conclusion. While we've also been speaking, Northvolt has announced that its CEO, Peter Carlsson, is going to step down. This is the Swedish battery maker, files for bankruptcy, Chapter 11 in the United States. More to follow on that. This is Bloomberg. I want to talk about what's happening with the European car industry. So within the last few minutes, we've learned that Northvolt's CEO is going to be stepping down. That doesn't come as much as a surprise, given the fact that this European battery company has filed for Chapter 11 over in the United States. Emblematic, you could argue, of the crisis that is gripping the auto sector on this continent. Craig Trudell joins us now, our autos editor. Craig, how can you build EVs if you can't build batteries?
I think ultimately the answer to that question is going to be we're going to have to rely on likely Chinese, maybe some Japanese and Korean companies to come into Europe and make them for Europe in the region. I think Northvolt was really sort of the best hope that Europe had for a sort of homegrown company that would be able to handle this. And the amount of investment that went into this company, the prominence of some of their backers, I mean, Volkswagen, Goldman Sachs, Bailey Gifford, BMW, there were a lot of blue chip names that piled into this company.
So this is an industry effort that's gone sideways rather than just one specific business.
Yeah, and government too. I mean, there was a whole lot of backing that went into this company. There were the CEO, we should mention, was a Tesla veteran. There were a lot of big names that sort of gave you reason to be optimistic about them being able to pull this off. But I think what we've seen is that China has really just, sort of stolen a march on the world in being able to scale up and get to a point where they have so much capacity, so much overcapacity, and that's something that you hear so much from the West, is that they've driven prices so down that competition just cannot make it.
And we started with our programme with a chart that showed just that. Craig, thank you so much for joining us, taking us through the story. Craig Trudell, talking about cars. Guy, I feel we have not provided very much that is of an uplifting nature this morning.
Let's talk more about cars. It's the Vegas Formula One this weekend. There you go. That's a nice little transition into the weekend. Something for Anna to watch this weekend. I know she's going to be absolutely glued. Ski season starts, so a number of the high resorts open this weekend. So Val Thorens.
Will there be snow?
So there's lots of snow. Loads, in fact, loads of snow.
It's cold here, so I'm assuming there is snow elsewhere.
In fact, it's snowing heavily. High winds are a bit of an issue, though. The Dolomites haven't had much yet, but the high resorts like Val Thorens are there.
And Las Vegas apparently looking forward to the F1. F1 fans spend 3 times more in Las Vegas than the average visitor. So I was reading from our Bloomberg Pursuits team. So those in Las Vegas watching the economy there will be in for something of a shock. That is it, I think, for this hour of the programme and for this programme for this week. Yes, indeed. We'll leave you with news that traders are now pricing in 150 basis points of ECB cuts in 2025. That kind of sums up the morning we've had, really, doesn't it, in terms of European data. That's been the direction of travel. That is it for the opening trade. The Pulse is up next. Have a good weekend, everybody. This is Bloomberg.